What's going on, everyone? So, I'm gonna come at y'all with another stock today. And what stock is that gonna be? Well, before I get into that, I like to say this. I am trying to build my dividend portfolio. Why am I trying to build a dividend portfolio? For passive income. I don't want to work forever, and this is one of the way you build passive income with the extra income you have. But you have to also remember, why are you buying these stocks? It's to build a passive income. Yes, if I'm building a passive income, I need to make sure they're good companies I want to own. You're owning part of a business, and that's what you need to remember. Now, what is the requirement? Well, this isn't my retirement account. This is my bridge account to help me bridge my retirement and for my working years. And this is where I'm putting my extra money. So my first requirement is, since I want to build a passive income, is to have it pay a dividend. It doesn't need to be a big dividend since I have a long time before I retire. And then number two, it has to be financially stable. I do not want to own a company that's in the negative. And this is the thing. You're owning a piece of company, and who will want to own a company that's spending more than they make? I just does not make sense. And number three, it has to have good opportunity because this is a portfolio that's built on good growth and pays dividend. There's a very small few stocks that do this, mostly in tech, mostly in industry that is very volatile, but you have to find the ones that has a good growth with a dividend paying stock. Now,
for passive income. Passive income looks like this. You take money that you can afford to go to zero and you put them in the two places that have historically created passive income. Public markets that you don't care if it goes up and down and you just wait to the end, or real estate. And you hope that your real estate area doesn't get crushed. Everything else almost doesn't exist.
comment down below, what do you think about all that, and what is your requirements for your portfolio? Not everyone has the same, and this is my portfolio, and this is how I like to do it. Now, I don't like to do deep dive. After I read the Intelligent Investor, it made no sense to go into all the nitty gritty details. Just stick to the basic, and this is what my channel is about.
I rejiggered my mind and when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought businesses that happened to be publicly traded.
It's not about going complicated, reading the candlesticks or anything like that. So if you're trying to find something like that, I don't see the point of it. I did it for years. And matter of fact, I did it for 5 or 6 years, and it was pointless. It was just stressing me out trying to read numbers. And the whole point of owning a stock is owning a piece of a business. So let's get into this stock. What stock am I trying to get into? It is McDonald's. I thought it'll be interesting since, I do go every once in a while eat at McDonald's. And if you don't know what McDonald's is, it's a fast food chain that serves, junk food and everything else like that. A lot of people use it. And the whole point of this is, hey, do I want to own a piece of McDonald's as a business owner? I don't want to open a McDonald's. That's too much work. But if I want to do something to own a franchise, instead of owning a franchise, why not own the actual business? So I looked into it, and it's no point of owning $100,000, $200,000 investing into a McDonald's. That it will take a lot of time to run. So this is why I'm looking to owning the business. Now, I do like to use MSN because it has a bunch of little cheat sheets on here that if you don't know what it is, that it tells you. So let's get into this. So 1 month, it has a 9.13% negative growth. 3 months, 4.63. 1 year, 0.12 negative. 1 year, it has a 15.45% 1 year growth. That's pretty good. 3 years is 23.53. That's pretty good. 55.19 growth for 5 years. So that's a pretty good growth. It's not the best growth opportunity, but it's still pretty good. Now, let's go ahead and look at the McDonald's dividend. So it pays a 2.44% with the annual dividend yield of $7.08 a year. It has a 62.48 payout ratio with a dividend growth of 6.89% with a 50-year growth. So it's a dividend king. Pretty good stock, it looks like. But let's look in more in detail about it and summarize it and all. So annual dividend growth is right now is $7.08, and recent changes increase it by 55 cents in December. So it's having pretty good growth, and that is a good thing if I'm looking for a dividend growth. Now, let's go ahead and look at all that. The dividend history looks fine. So the only thing left really is to look at the finance. How is McDonald's doing financially? So 22 billion. I like to see the track record of year over year what it grows. Did it shrink down? Did it grow? Now this is in the billion, so I expect it to grow a little bit. The number's not going to move very fast since we're talking about billion, but we are talking about a little bit of growth. 22, 21, 21 billion, 19 billion. That makes sense because that's the COVID year. Now it jumped up to 23.2 billion, 23.1 billion, 25.4 billion, and 25.9 billion. Now, that's the revenue year over year. That's a very slow growth. So what I expect is the growth of the company to be very slow too on the cost. Now, I could go into the details, seeing the cost of good and how they do it, but it does no good if the gross margin is bad. Well, the gross margin of this is 56.75%. So if we look at the gross margin, if you don't know what a gross margin is, it says the gross margin is revenue minus the cost of goods. So higher gross margin better, and it's at 56.75%. That's some crazy gross margin. I'm not worried about them paying a dividend, especially when their net profits is 31.73%. So you have a great profit margin. Now, financially, it is in a good standing. It's making good money, but let's make sure and look at the cash flow and the balance sheet. So what I like to do is see what the current asset and fixed asset, what are they worth? It's about 54 billion. And then let's see what is the current liability and long-term debt. 38 billion in long-term debt plus 3 billion. So you're looking at 41 billion in debt. That's pretty high for what they're doing. Well, let's check the cash flow, see how their cash flow's been doing. So 9.45 billion, 9.6 billion. Interesting. The operation cash flow jumped from 7.3 billion to 9.6 billion in 2022 to 2023. That's pretty high jump. And then you have a 6.6 billion in free cash flow. Now, if you don't know what free cash flow is, the definition is right here. If you go over it, it's the money left over after paying operating expense and capital expenditure. So this is just leftover money. I like to see it because that's the real telltale of a company. If they're going down or going up in their cash flow is what really matters for me, because that's how I know if they are stable. If you start seeing their cash flow to go down, that means they're not doing so good. So let's see what the analyst says to do on this. Well, for that, let's see what investors are here. Well, you got BlackRock, Vanguard, and JP Morgan, and State Street. They're pretty good people. Let's see who's selling. Citadel selling and State Street selling. That's interesting. All right. Now let's go into AI. So what does AI say about it? Valuation 3 out of 6. Okay, I see that. That's pretty reasonable. Earning is 0 out of 6. Revenue growth is worse than the peers. Yes, I agree. It doesn't have a big revenue growth compared to everyone else, especially how big they are. It has very small numbers. Future growth, 2 out of 6. I agree with it. I don't see it growing very well. Historical performance, 1 out of 6. Financial health, 5 out of 6. Financial health, I believe, is good, but I do agree with the future growth of 2 out of 6 in the performances, just because if you look at this number again, it hasn't been doing too good year to date. They did grow 15% over 1 year and 23%, but it looks like they're on a decline at this time. And it could be a lot of different reasons. Now, doesn't mean it's a bad company, but looking at the finance and the financial growth, it hasn't been looking too good. Now, the analysts do say buy, and this is where I'm going to disagree with the analysts on this one. Based off the finances right here, it's not growing dramatically. It's a good blue chip company, but financially it's not growing dramatically if you want that good growth. Now, they are a good blue chip company, and this is what y'all need to understand about McDonald's. So McDonald's, am I going to add to my portfolio? And this is what everyone needs to understand. McDonald's is not going to do me too good in my dividend portfolio. They are a dividend aristocrat or dividend king. They have been paying a good dividend. And the reason why I'm not adding them is I don't see that growth opportunity in them like I want to see. I want to see a 13 to 20% growth year over year. And it's just not that good. Since it's not that good, that's the reason why I'm not buying. But it is a good blue chip company. Well, so it will grow about 7%, 14% year over year. So it does have a good growth. It's just not good enough for my portfolio. Now, the dividend is pretty good and financially it's stable, but the financial growth of it is not that good. And this is the reason why I'm not buying. Also, in the future, I don't think all these health nuts and everything's going to help McDonald's. I think more and more people are going to be health conscious. McDonald's used to be a really cheap place, and they're not so much anymore. So the pricings of McDonald's is really not helping the poor people and the people that needs it. So it used to have a really good diet menu, good cheap meal that you can fill your family. Now it's too expensive. So that's what I got to say about it. Like and subscribe. I won't be adding this to my portfolio. It just doesn't look like it's going to have a good growth in the next few years. I might revisit by next year to see what's going on with it. But right now, it looks like it's on a decline. Financially, it's not growing. And it just doesn't look like I want to add this to my portfolio. Thanks for watching. Like, subscribe to my video.